I'm Llanes with WealthNet Investments. It's been a real challenge if you're about to retire right now. And I think what's happening in a lot of people's minds right now is they're trying to figure out how in the heck am I supposed to invest in this environment? Interest rates are really low. It appears that the Fed is going crazy. I'm scared with the bond market. I don't know that the bond market is going to hold up. Stocks look expensive to me. So it just seems like a really hard thing for a lot of people. So I want to talk a little bit about strategy and how you overcome some of these challenges. So let's first start off with the challenge of fixed income. And we'll talk about what that challenge is and then ways that we find are effective in dealing with that strategy. Okay, in the fixed income market, we know that interest rates are near zero. We know that the Federal Reserve has been pumping a lot of money. And we know that there's increasing concern about rising inflation. And, when inflation does rise, that leads to generally higher interest rates, which actually erodes the value of longer dated bonds, longer maturity bonds. So if you have to go out and reach for yield and you're going with a longer duration, there's a really good chance that you could lose money if inflation starts increasing. So that is the biggest concern. So one of the things that we look at is we compare what those yields are in the tax-free bonds, especially if you're in a high tax bracket, versus the taxable bonds. And what we're finding is that the tax-free instruments are generally more attractive for many investors. So especially if you have high income. So if you're going to be going into the fixed income market, it's in our estimation, it's really more of a preservation of capital type of a strategy and getting some offset to the potential for rising inflation and staying into shorter dated instruments. Now, there is a potential that we have zero interest rates and that we have a massive drop in interest rates, and we're starting to see more and more evidence that that could happen. So one of the strategies that we are employing is to barbell that and to have some very long dated instruments, and we don't have to have as much of it because they're more volatile, but to have some very long dated instruments that could benefit if we have zero interest rates and we could get significant capital appreciation. Believe it or not, even from the levels where we are right now, in a long dated instrument above 10 years in maturity, you could have significant capital appreciation. So having some money there makes sense to us. The other part about the fixed income market is that there are some instruments out there that have higher guarantees. And we're in a very unusual type of a situation such that if you're retiring soon in the next 5 years or in the next 12 months, that it makes sense to potentially have some money in guaranteed instruments that are paying 5.5%, 6%. And you know that it doesn't have any interest rate risks to it in that you do not see values move up and down. So there's a concept called time-segmented retirement income planning, where basically you segment out pieces of time of your retirement income needs over time, and you basically invest in different ways where you somewhat immunize your portfolio for market risks in the shorter term, and then as you go longer term, you have more longer dated instruments with more risk assets like stocks and real estate and things like that. So there's some advantage to that, but there's also some real problems to that, because how you actually do it, how you implement it, will have a lot to do with how well you do. There's some research out there, and I will put this in the show notes, by Wade Pfau, that shows that when you're taking an approach where you're basically customizing your need, you're looking at your capital needs each year and then adjusting appropriately from that angle, that's much better than purely immunizing, because you tend to have too much bonds, and if your stocks are underperforming, you may be selling stocks at the wrong time. So it's really important to have a strategy that works on an ongoing basis and is dynamic to performance of the asset classes and valuations. So I'm not a huge fan of time-segmented approaches that are pure. I think there's a way to look at it, and simply because returns are not necessarily always due to time frame. You know, you might look at a long-term statistical analysis that shows there's a relationship, because there is a relationship between the longer time frame you own stocks, for example, the lower the range of returns annualized will be. You know, in other words, you'll have more of a certainty knowing that you'll have a positive rate of return the longer you own stocks. And you also have a higher probability that stocks will outperform bonds the longer you hold them. So, but I think that you can go through periods of time and you can look at isolated years where, depending on when you retire, where that relationship does not hold up. And unfortunately, we live in the real world. We have to manage to those possibilities. So a pure time-based approach is not, it needs to be adjusted. It's a good framework, but it needs to be adjusted. Anyhow, so getting back to being an income investor right now. And when I say being an income investor, what I'm really saying is investing so that you can have a sustainable withdrawal rate in your portfolio, but preserve capital at the same time, and have a growing stream of capital and a growing stream of income over time. Because, you know, for the average retiree, if you just look at the inflation rate, and I actually calculated the statistics, the average retiree is going to see in their retirement lifespan, which is typically 20 years, it could be even up to 30 years, you're going to see expenses go up by, say, 1.4 to 2.8 times. So you could see a double easily in your expenses. You have to be prepared for that. So you need a growing income stream. It can't be just something static. So that's why we have to look at equities. Now, we look at today's environment, we see, wow, the equity markets is very expensive. And, you know, to some people's mind, the markets are just way overblown. In fact, JP Tremblay and I had a conversation last week on our kind of a market coffee talk segment we did. It was about an hour long. If you get a chance and didn't get a chance to hear that one, you can go back there. I basically let JP talk most of the time because I really wanted to hear his, I didn't want to interject too much. I wanted to hear his viewpoints. But if you look at the equity portion of the portfolio, one can make an argument using traditional analysis of valuation that we're well ahead of ourselves in many stocks. And we've talked about how the market is, the opportunities are getting more and more focused. So I think the way that we want to, the way that we're dealing with this is that we are dealing with the investments that have opportunities for growth regardless of some of these more macro issues. And I'm not going to get into all the different macro issues here today, but basically investing in stocks that have the capability of earning regardless of what happens with the COVID scenario, lockdown scenario, regardless of what happens with the business cycle. And there's very few stocks that will fit that bill. The traditional value stocks may not have as much opportunity in them as they had in the past because we're going through a cycle now, an innovation cycle, that is basically means there's more innovation, so therefore the old companies are really needing to either adapt or acquire more innovation for the new economy, or they're going to die. And so some of these companies that are deep value stocks, if you will, that traditionally you would see bounce, may not bounce, may not become good investments. So deep value as a group has been pretty hard to invest in. So we really have to keep on top of the innovation cycle in this kind of economy where we are right now. We're about to go through, it feels like we're going through such a cycle that we're going to see complete displacement of industries, complete displacement or reduction in demand in certain areas. For example, real estate may have a structural change in the demands for real estate. We'll see more and more people probably continue to move. And so taking advantage of those types of trends. Now, traditionally, when you looked at investing for income, getting back to our theme, most investors have said, let's build an equity income portfolio, and let's find the stocks that have the best yields and that still have good growth. Now, I think that's a good strategy with a portion of your money, but you don't want to be too invested in that because most of those companies tend to be in the older economy. It's harder to find growthier names that fit that bill when you put the valuation angle on it. So let me just give you the example. So this week I ran some screens for equity income, where we're looking at, give us the companies in the United States that are in the S&P 1500. So it's large, mid, and small companies. And let's take a look at those companies, and let's just look at the companies that are above the median in their industry in terms of dividend yield. In other words, they're giving you a better than median dividend yield right now. So just eliminate the other ones because we want to get a yield. And then I also put on there a screen where we're looking for companies that actually have growth potential. In other words, they're growing their earnings, they're growing their dividends, and that also are not overvalued. In other words, they have a reasonable valuation. You get a pretty small list there, and many of the names you would know that wind up being on that list. And if you look at one of the metrics that we like to look at is the total return ratio, which is basically saying, okay, how fast can they grow? And how much are we paying for them, and what kind of yield am I getting? So if we can get a good valuation with good growth, that's a kind of a GARP, or a growth at a reasonable price philosophy, and get above average dividend yield, that's a bonus, and that should be in the portfolio. Well, there's not a whole lot to choose from there. And if you want to have a diversified blend of sectors, you're going to have to accept a smaller yield. So in order to get the returns that are necessary for an income investor, for many people, it's going to need to be a total return approach where it's a combination of capital gain that you're spending down as well as dividend yield and interest, primarily tax-free interest. Maybe some guaranteed income investments in there that are going to give you 5 or 6%, so that you could have less interest rate risk, maybe in the next 1 to 5 year time horizon, maybe as long as 10, depending on your situation. So we have got this down to a science in our firm. I mean, we look at this in many different angles, and we start off with the financial plan. What are your capital needs over time, and estimating the goals and what they look like, and then it's honing down and fine-tuning a portfolio, but making the portfolio flexible enough so that it can be adjusted as the capital markets adjust. So protecting your capital, ultimately, that is the first thing, making sure the capital is protected. But in today's environment, you can't just do it the way your grandfather did it. If you want to have an income portfolio, you can't invest that way. And you might even need to have some gold in there. You might have to have some precious metals. We may have a reflation in the economy, or inflation pop in the economy eventually. It may not come right away, but it may come in the next 5 years, maybe next 10 years. I would be surprised, actually, if we didn't have a rise on the demand side such that we have an increase in inflation. So it can be done. You can be successful in this market, and you have to be successful in this market by really just looking at valuation, growth rates, yields, protection, diversification. It's totally doable, and it's a sleep at night factor. But many people hold too much assets in cash, and too much assets in the wrong stock, in one type of stock only, which we also don't recommend. So if I could just summarize that. Our strategy for developing solid income, sustainable income from a portfolio that also can grow over time is a combination of things. It's a combination of equity income, good growing companies at a reasonable price with above average dividend yields. It's a combination of growthier names that are in the innovation economy that we can take money off the table as those companies grow and use that to generate income. It's a combination of shorter term instruments that are tax-free, that are very secure and high quality, that don't have a lot of interest rate risk, combined with a little bit of long-term, very long-term, just in case we get 0% interest rates, so that we can benefit from that if that does happen. And then also having some solid guaranteed investments that are going to give you better than the short-term yields that are going to give you like 5%. Maybe you get 2% above inflation, and but not going too far out on that. And then buying those stocks that are the innovators, I think, is a big part of your success in this economy, because we are going through some change. There's going to be a lot of growing pains. There's going to be changes in policies with the government. There's going to be changes in tax policies. There'll probably be more fiscal stimulus towards the middle class. There'll probably be, maybe there's some higher taxes on the rich. There's lots of things that are likely to come down the line here over time that are going to affect investments, and you just have to have a strategy that is robust enough to deal with these things. So you can't just take a single approach. So for those of you who have thought like I just want to live just off the interest, I think that's not a good idea, because if you live just off interest, you're likely to have very, very poor results. And it would be, I honestly don't believe that that would be being a good steward of your investments if you did that. Anyhow, income investing can be done. Retirement can be done right now. And there's no need to fear this market. I think people are overly fearful of what's going on in the market. That I think if you have good risk management techniques, and that's something I didn't bring up, but having a security by security risk management protocol, and buying more of what's working, reducing what's not working, is crucial. All right, that's my thought for today. If you're thinking about retiring soon, let us know. We could do, actually we're doing a new free retirement plan that is actually looking at the income forecast for you and is giving you ideas on what would be the optimal way to get to that goal for your retirement income. All right, Louis Llanes with WealthNet Investments signing off. Have a great day.